When discussing income, two terms frequently arise: net income and gross income. These terms are important for understanding finances, whether for personal budgeting, business accounting, or tax purposes. Gross income refers to the total earnings or revenue before any deductions. For individuals, this includes all wages, salaries, bonuses, and any other income sources. For businesses, gross income is the total revenue generated from sales or services before subtracting costs like expenses, taxes, and payroll. Individual example: if you earn $100,000 per year in salary, your gross income is $100,000. Business example: if a company sells products totaling $100,000, this amount is their gross income. Net income. Net income, sometimes called net profit for businesses or take-home pay for individuals, is the amount left after all deductions are made. This includes taxes, health insurance, retirement contributions, loan repayments, and other expenses. Individual example: if your gross income is $100,000 and you have $30,000 in taxes and deductions, your net income is $70,000. Business example: if a company has $100,000 in gross income and $75,000 in expenses, its net income is $25,000. Key differences: gross income, total earnings before deductions. Net income, earnings after all deductions. Understanding the difference between net and gross income is crucial for financial planning. It allows individuals and businesses to budget effectively, ensuring they account for all expenses and obligations. Conclusion: when you see a figure like $100,000, it's important to clarify whether it's net or gross, as this distinction significantly impacts financial reality. Always consider deductions to understand how much money is truly available for spending or reinvestment. Understanding net versus gross income. When discussing income, it's crucial to understand the difference between net and gross income, as these terms are often used in financial contexts and can impact financial planning, budgeting, and tax obligations. Gross income. Gross income refers to the total amount of money earned before any deductions or taxes are taken out. This includes all earnings such as salary, bonuses, commissions, and any other sources of income. It represents the overall earning capacity and is often used for setting budgets or assessing financial health. Example of gross income: imagine you have a salary of $100,000 annually. This amount is your gross income, as it reflects the total earnings before any other costs, such as taxes or benefits, are subtracted. Net income, on the other hand, is the amount of money that remains after all deductions have been made. These deductions typically include federal and state taxes, Social Security contributions, health insurance premiums, retirement contributions, and any other applicable expenses. Net income is essentially the take-home pay, or the actual amount you have available for spending and saving. Example of net income, continuing with the example above: if your gross income is $100,000, various deductions might amount to $30,000. Thus, your net income would be $70,000, which is your real earning after all necessary deductions. Importance of knowing the difference. Understanding the distinction between net and gross income is vital for several reasons. Budgeting. Knowing your net income helps in creating an accurate budget for your expenses and savings. Tax planning. It's essential for understanding tax liabilities and planning tax-related strategies. Loan applications. Lenders often consider gross income to assess credit worthiness, but knowing your net income helps in understanding affordability. Financial goals. Setting realistic financial goals requires a clear picture of the actual disposable income available to invest or save. In summary, when you hear figures like 100,000 net or gross, it's essential to clarify whether the conversation is about total earnings before deductions, gross, or the actual earnings after deductions, net, to make informed financial decisions. Next chapter, understanding net versus gross income. When discussing income, especially a figure like 100,000, it's crucial to distinguish between net income and gross income. Both terms are widely used in finance and personal budgeting, but they represent different amounts of money. Gross income. Gross income refers to the total earnings before any deductions are taken out. This includes salaries, wages, bonuses, rental income, any other forms of income. For example, if you have a gross income of 100,000, this is the total amount you have earned over a specific period, such as a year, before taxes and other deductions. Net income. Net income, on the other hand, is the amount you actually take home after all deductions. These deductions may include federal and state taxes, Social Security and Medicare contributions, retirement plan contributions, health insurance premiums, for instance.
Interest rates in financing refer to the cost of borrowing money or the return on investment for lending money, expressed as a percentage of the principal amount over a specified period. Essentially, it represents the price paid for the use of money, which can vary based on factors such as the creditworthiness of the borrower, the duration of the loan, and prevailing economic conditions. Interest rates play a crucial role in determining the affordability of loans, influencing consumer spending, and shaping investment decisions. Higher interest rates typically indicate a higher cost of borrowing, while lower rates can stimulate economic activity by making loans more accessible. Next, interest rates in financing refer to the percentage of a loan amount or investment that is charged or earned over a specified period, usually expressed on an annual basis. It represents the cost of borrowing money or the return on investment for savings and investments. Interest rates play a crucial role in determining the overall cost of loans, such as mortgages and personal loans, as well as the potential earnings from savings accounts or bonds. Higher interest rates typically indicate a higher cost of borrowing, while lower rates may encourage spending and investment. Understanding interest rates is essential for making informed financial decisions, as they can significantly impact personal and business finances. Next, a Roth IRA and a 401k are both types of retirement savings accounts, but they have several key differences. Tax treatment. Roth IRA. Contributions are made with after-tax dollars, which means you pay taxes on the money before you put it into the account. However, withdrawals during retirement are tax-free, including both contributions and earnings. 401k. Contributions are typically made with pre-tax dollars, reducing your taxable income for the year. You pay taxes on withdrawals during retirement, which includes both contributions and earnings. Contribution limits. Roth IRA. As of 2023, the contribution limit is $6,500 per year, $7,500 if you are 50 or older. 401k. The contribution limit for 2023 is $22,500 per year, $30,000 if you are 50 or older. Employer match. Roth IRA. There is no employer match since it is an individual account. 401k. Many employers offer a matching contribution, which can effectively increase your retirement savings. Withdrawal rules. Roth IRA. You can withdraw your contributions at any time without penalty. However, to withdraw earnings tax-free, you must be at least 59.5 years old and have had the account for at least 5 years. 401k. Withdrawals before age 59.5 may incur penalties and taxes, with some exceptions, like hardship withdrawals. Investment options. Roth IRA generally offers a wider range of investment options, including stocks, bonds, mutual funds, and ETFs, depending on the financial institution. 401k. Investment options are typically limited to a selection of mutual funds and other products chosen by the employer. Income limits. Roth. IRA, there are income limits that determine eligibility to contribute directly. For 2023, individuals earning over $153,000, $228,000 for married couples, may have reduced contribution limits. 401k. There are no income limits for contributions, making it accessible regardless of how much you earn. Understanding these differences can help individuals choose the right retirement savings option based on their financial situation and health.